what according to you is the best way to build wealth?
I think never get carried away by the easy or the quick remedies.
So hi guys, welcome to this series of podcast on building wealth smartly. We have Aashish Somaiya. Hi Aashish, very excited to have you today.
Thank you for having me.
Perfect. So those of you who don't know, Aashish is the current CEO of Whiteoak and was the CEO of Motilal Oswal Asset Management. If you could just tell our viewers what Whiteoak does. We're all familiar, but just for the viewers.
Yeah, so Whiteoak is actually an investment management firm, which manages money into Indian stock markets for domestic as well as global investors. Approximately $6 billion in assets. Out of this, 75% is managed for foreigners investing in India, and about 25% managed for Indian investors. And we are about to launch, even our series of mutual funds, maybe starting next financial year.
Wow, perfect. So, so you're from the equity markets, right? And all our viewers would love to know, how did you start your investing journey? What, according to you, was your first profitable investment, right? We would love to know that because you're been in the market for so long.
Yeah, so how I got interested in the markets was way back when I was in my engineering college. That was, say, in the early 90s. So while when I was in college, science college and then engineering college, so somehow all my friends, although we were in a hostel, I used to have a bunch of friends who were studying engineering, but still they used to read the pink papers, and the Harshad Mehta scam was just fresh, and the newspapers were full of coverage at all points in time. So in a very not in the right way, maybe probably for the wrong reasons, but it instigated a lot of interest in people with relation to the stock market. So although I finished my engineering and I worked as an engineer in a factory for a year, but then eventually, I wanted to get associated with finance and the markets. So I think purely early exposure, purely because of the kind of friends I had, all my seniors and everybody was interested. I actually can't recall my first profitable investment because if you ask me personally, for the first few years, I would have said that although I was in the field for the first 10-12 years, I would say I was just a dabbler. I never made any long-term strategic investments, really speaking. It was all very cash flow based. When I had money, I invested. When I needed money, I withdrew the money. So I don't think I have any such stories that, I invested 30 years back and this is how it has grown. I have become a serious investor. On the personal front, I've become a serious investor maybe only in the last 10 years or so. But otherwise, early days, I was like any other youngster. I didn't have much money or didn't have much savings.
Great.
Okay. So in your early days, did you have any philosophy, and how do you think your philosophy of investing in stocks has evolved over the years?
So, actually, the fact that you have to have a philosophy, or let me put it simply, the fact that you have to have a recipe or an approach, that realization has come over the last, say, a decade and a half. Because look, when you are younger, right, at least when I was younger, I used to see the world very much in terms of, this is the right way of doing things, this is the wrong way of doing things, this is black, this is white, this is good, this is bad. So when you're younger, you have this penchant to look at things in a very deterministic fashion, right? So in your early days, you start thinking that this is the right way to invest in the market and this is the wrong way to invest in the market. But over a number of years, when you see many cycles, you spend a couple of decades, then you realize that there's no one way to approach it. So, human mind, I don't know if you realize this, but human beings, the human mind is not attuned to operating well in the stock market, because human beings need closure. Human beings need clarity. So whether it is a relationship, whether it is, investments or anything in life, we would like to have closure. We need, like for example, today the market falls. Most human beings will look at the TV and say it fell because of Russia and Ukraine, right? 2 days back, they will say it's because US is raising rates. But the reality is that there is a multitude of factors which is impacting at any given time. So what I find is that there's no right way of doing it. It is all context and perspective. And philosophy also is not just one philosophy which works. That is also contextual, and it needs perspective. So you should have your philosophy, right? But you should never think that there is no other way to operate. So that's why I'm not very, very caught up or very carried away with philosophies or deterministic approaches. I have learned to view things in a context, that in this context, this is what will work, but in yet another scenario, something else will actually work. And human beings by nature, being very, very oriented to finding closure, finding explanations, finding reasons, they find it difficult to navigate stock markets.
And I think in today's context, you need that human element because data cannot predict that COVID is supposed to happen or the Russia-Ukraine war is supposed to happen because that is affecting the markets a lot. So the question that I would want to ask is, in today's context where everything is so volatile, how are you navigating the stock market? Because some sectors are doing very well while the other sectors are performing extremely bad.
Yeah. So see, there are certain times, like for example, if you describe a war scenario, for instance, it's always first of all, it takes people by surprise. Then it's a evolving situation. And like I said, if you land up somewhere, somebody asks you that, what should I do? The other urge is to give an answer. I personally feel that it is perfectly fine many times to do nothing and to say, I don't know.
Yeah.
Right. I think that is a very, very essential quality. Like generally speaking, apart from being, like I said, all of us as humans, apart from being very deterministic and very outcome oriented and seeking clarity, other than this, apart from this, there is another trait which we have, which is that we find it very difficult to say I don't know, or say that, like for example, today in certain circumstances I would say don't do anything. It's not necessary that you have to act on information, right? So many times when it's a warlike situation, when you are landing up into darkness, you don't know how this will play out. It's better not to do anything, because it's complete darkness. So it's better to let things evolve and not do anything, meaning we're not talking about not doing anything for 3 months or 6 months or 1 year. Not do anything for a day or 2 days or 3 days or 7 days. Let more clarity emerge and then maybe act either way. So it's important to not do anything at times, and it's important to say I don't know when it is, when it is better to say I don't know actually.
Correct. And certain sectors such as technology, they're doing very well. And I think we're kind of seeing a repeat of what happened in 2000 where there was a bubble.
Yeah.
A lot of technology companies, they're being valued at 100x revenue multiple. Whereas there are a lot of cash-rich companies as well, which are being valued at a very low multiple. So a lot of people are valuing these technology companies based on future growth of monetization, which is there.
Yeah.
So just wanted to understand from your perspective, what are the factors that you look into when you're evaluating a particular company to invest in?
Yeah, so see, there is this whole two things in your question. One is I'm not in the camp which is drawing parallels to what is happening with some tech companies. A lot of people are drawing parallels with the US. Meaning, look, there is a big crash in the US tech sector. US tech sector drawing parallel with India's tech sector, I think completely flawed, because the size of our market, the size of, where we are in the evolution of our tech sector, all of those things are just not comparable to what is happening in the US. The second thing is that in India, there has been a rally from 2020-21, correct? In US, COVID was a few weeks of a phenomenon. Other than that, right from the end of global financial crisis, US has been on a tear for last 12 to 13 years. Before this collapse of, before the collapse of fag end of 2021 and early 22, before this collapse in the US markets, before that, the 10-year CAGR of NASDAQ 100, 10-year compounded return was 25%. It was 10x in 10 years. That's not comparable by any stretch of imagination to what is happening in India. We are in a nascent stage of evolution. Same way, this is not comparable to what happened in 99-2000. See, it's very, very important to be informed by your past experience, but it's irrelevant or it's wrong to be colored by your past experience. There's a big difference in these two. So I think India's tech sector has a long way to go. And it's still the early days. The second thing is that market makes, like you asked, criteria for what do we look for. You should read, for example, there's a very famous analyst who writes on stock markets and equities. His name is Michael Mabuzin, currently employed with Morgan Stanley. But in the past, he has been a thought leader and, employed with various organizations like Credit Suisse, etc. He wrote way back in 99-2000, very famous book called Expectations Investing, which says that stock market movement is not directly correlated with growth of profits. Growth in profits doesn't closely explain the rise of share prices. What closest explains the rise of share prices is increase of free cash flow for a company over a period of number of years. So it is most correlated to cash flow, not correlated to profits, because profits are accounting numbers. So it is most correlated to cash flow. And when we look for it, we look for cash flow generation in excess of cost of capital, because cost of capital is your opportunity cost. So we are not very perturbed by, you know, that stock prices in tech sector have fallen 30-40% and all. And we will see each company individually on merit and for what kind of cash flow they can generate in years to come over and above their cost of capital. That is what we will look for.
Coming to your personal portfolio, personal investments, right? I mean, just you're a dear friend, mentor, advisor, and you know, based on a couple of past discussions, we know you've also invested in an asset class which is real estate.
Sure, yes.
So we would love to know, you know, a veteran like you, equity markets, that's what driven you over the years. What made you invest in another asset class which is real estate? What are your thoughts behind real estate as an asset class or an investment class?
Sure. So, you know, a lot of times when people talk about asset classes, the thought that is foremost in their mind is diversification.
Yeah.
And, you know, investing in a bunch of uncorrelated assets. That's the right way to do it, by the way, for diversification and, you know, for creating a optimal risk return balance in your portfolio. So that's the right thing to do. But if you ask me, for example, I invest in, you know, I started investing in real estate, not necessarily for diversification or low correlation.
Okay.
For me, it is a aggressive investment, or it is a investment which is in line with equity, because I think real estate in that sense is closest to equity. So, you know, a lot of times people make this mistake that they're very bullish on the economy, they're very bullish on the stock market, but they are not bullish on the real estate segment. I think in India, real estate over the last few years had its own set of quirks. It was regulatory changes, it was consolidation in the industry, it was, you know, new compliance coming. So last 10 years, it went through a lot of adjustments. But I think on a long-term basis, one cannot be bearish on real estate if one is bullish on the economy or the stock markets. So I invest in real estate purely for growth, actually, over a long period of time.
Sure. So when it comes to growth, right, appreciation in real estate, what is your perspective on commercial real estate as an investment versus residential as an investment, based on obviously your own portfolio and your learnings from the market?
So commercial real estate, you know, see, there are two things in this. Obviously, everybody knows that in commercial real estate, it's not like you're going to have 2x, 3x, 4x, and it's not that kind of growth. But there are two nuances. One is, I think it's a very, very good replacement for fixed income, right? Second, I think the beauty about real estate, and, you know, has to be used rightly.
Yeah.
So whatever I'm saying, you know, people should definitely consult a professional advisor, and not necessarily just go with what I'm saying. I'll share my perspective. But the beauty about real estate is it's probably the only asset class where you put 1 rupee and the bank is willing to give you 3 or 4 rupees, you know, for you to be able to buy that asset. Correct? It doesn't happen anywhere else. And traditionally, if you ask somebody who's going to advise you on finance, or who's, you know, advisor, most people say that borrowing is bad. Okay, or, you know, leverage is bad. That's the general. It's not wrong, but I would say that if you leverage for the right reasons, with enough security behind it, and you have the holding power, right? Then I think it's the right thing to do. So, for example, when you look at, say, any real estate in any form, if you have 1 rupee, right, that's the only asset class where if you have 1 rupee, you can create a balance sheet of 5 rupees, or you can create an asset of 5 rupees. It doesn't happen anywhere else, correct? And if you are talking commercial real estate, for instance, what will happen is that if you have grade A properties, if you have the right tenants, and you hold for 10-15 years, eventually, you know, it's going to be cash neutral. The asset becomes yours without you actually doing much over a long period of time. So I think anybody who has a long-term horizon, see, everybody says that if it is 10 to 15 years long-term, you should be in equity. But equity, there is one catch, that with 1 rupee, you can create 1 rupee of asset. But with commercial real estate, there is a different arithmetic which works, that with 1 rupee, you can create 4 or 5 rupees of asset. It's not as simple as it sounds, because there can be times when tenants will have vacancies. There can be times when the rent will go down. So obviously you need a backup. You need enough equity to withstand any shock. But I think over a long period of time, there's no other way to create 4 rupees of asset with 1 rupee in your pocket, provided you have a reasonably long horizon, because then ultimately that asset becomes yours over 10-15 years, and then you can choose what to do with it.
So it's very interesting to hear your opinion on real estate, because you're pure play.
See, because I'm an aggressive investor, so that's why I'm presenting it in that light. I don't think anybody should think that this is a easy investment.
And just wanted to clarify, what do you mean when you say you're an aggressive investor?
Yeah, because nobody, I don't think that normally people would think that with 1 rupee they should create 4 rupees of asset.
Yes.
And it's not as simple as it might sound in a conversation. I already said that if you invest in commercial real estate, that location or that property can fall out of favor, right? Tenants can go in and out, right? Rents can go down, property prices can go up and down, occupancy levels can change. But the point is that in India in general, commercial property is getting more and more consolidated, more and more organized. And it's largely driven by financial services and ITES, which are reasonably secular kind of. So that's why I said, look, that's why I spend a lot of time in explaining my perspective.
Yeah.
That if I'm bullish on equities, I'm bullish on India as a country, bullish on the economy, bullish on equities, then I will supplement my equity investment with real estate. So I'm not coming from a diversification or risk reduction perspective. And the point is that I have always invested in equities. So if I have 100 rupees, how much can I invest in equity? Yes, I can put entire 100, but then I will also look for other avenues to increase my gains over a period of time.
That's, I think, a very interesting take on it. And is there anything when you look at investing into real estate, are there any particular factors you look at behind a property, that these are the factors which would make it a good investment?
No, so I understand equity. So for investing in equity, I don't need a advisor. But for investing in real estate, definitely, I have given you my hypothesis.
Absolutely.
Every investment is a hypothesis. I have given you my hypothesis. But when it comes to buttoning down the specifics, that, how does one really invest? How does one, how do you do an LRD and all those kinds of things? Definitely one would seek advice.
Absolutely.
So I bank on some advisors. I don't actually, of course, don't do it myself.
How do you think real estate as an investment class has, transformed over the years? Do you think back when you started investing in, was it still as let's say lucrative as we feel it is now? Like we can get returns up to 9% on commercial properties. How has it evolved over the years, the real estate market?
See, I think evolution is on 3 or 4 fronts.
Okay.
See, first I can tell you is that most of the times when when people invest in real estate, there's no benchmarking.
Right.
So it's a market which is full of conversations related to absolute returns. Right. Same way, like in private equity, you say number of X of multiples, right? MOIC.
Yeah.
Right, multiples of invested capital. So same way in real estate also, people have, over the number of years, people have bought land or people have bought some property and they've looked at multiples.
Right.
But I've seen that if you hold it for 10, 15, 20 years, you need some benchmark. Has it done better than equity? Has it done worse than equity?
Yeah.
Right. So I think that bit of professionalization in terms of how to measure returns, there are some managed products out there. So many things have started to improve. Second important thing is that in the past, it was always, businessmen who had, say, surplus money, they would buy real estate.
Yes.
Generally, you would not find professionals investing in real estate. I think that is also changing now.
It's interesting you say that, because we've also noted this quite a bit, that this notion in people's head that, once I reach a certain point in life, that's when I start investing in, real estate. That's when I have the capability. But most people don't realize that anyone from the age of 20 years to basically anyone can start investing in real estate.
Absolutely. In
these
fact,
days.
see, I'll give you another, since you said 20-year-olds,
Yeah.
like I'll give you an example, personal example. You asked me about when did I invest.
Yeah.
I bought my first house when I was exactly 26 years old,
Okay.
right?
Wow.
26 or 27 years old. When I was 26 or 27, I used to live in my mom's house, and bulk of my salary used to go in paying an EMI for the house. Now, in today's usual conversation, somebody
Yeah.
would say that you should not be borrowing and you should not be buying a house, because we're in a shared economy. So you would say that, why don't you just rent it? If you're 25 or 26, why would you buy a house?
Yeah.
The same logic applies, that real estate is the only place where I recommend leveraging. That how could I buy a house at 26? When I bought a house at 26, that house was somewhere around 75-80 lakhs,
Okay.
right? In 4 or 5 years, I would have sold it at 2 to 3x of. But the point is that there are certain circumstances in which, with the right advice, with the right arithmetic, certain circumstances, it makes a lot of sense to leverage for the right purposes, not
Right.
for being profligate or not for kind of, blowing up the money. So actually, like you said, it's not just about rich businessmen with some surplus who can invest. It's for everybody.
Absolutely.
It's
yeah.
relevant for everybody.
And that's what we're kind of trying to education, we've spoken before, and you've mentioned the importance of education, right? So we have now tried to incorporate that in our philosophy as well, education about.
Yeah, because there are a lot of wrong perceptions out there, right? For 10 years, like from 2010 till 2020, the sector itself went through multiple rounds of cleanup, right? Like when you had, say, GST, demonetization, the economy has gone through formalization.
Right.
From thousands and thousands of developers, maybe now we have few developers who are worth talking about and who are credible. A lot of them are getting absolutely professionalized and listed in the markets. Their financials have become transparent. Of course, you have better regulation with RERA. So many things have changed. It's become a more formalized, a more regulated, in that sense, a bit more bankable compared to the past.
Correct. Speaking of high returns that we, get in commercial real estate, these days we've noticed there's, a lot of buzz around alternative investment products like SIPs, mutual funds. There are debt products, coming into the market. How do you view them, like personally, like, as a retail investor, and also maybe as an institutional investor? Like, how do you view these kinds of products?
So, look, institutional investors is relatively simpler because, for them, institutional investors are ultimately managing money in a regulated fashion on behalf of some clients.
Right.
So for them, it's very clear that they will invest as per their objectives.
Right.
But, the point is that if you have multiple options available, then you can create certain combinations of risk and return and offer what ultimately a client needs. But if you're a retail investor who's investing directly on your own, making all these choices, then it becomes a bit complex because, it's well known that when there are more choices given, people make suboptimal decisions. And when there are too many choices, then their tendency to stick with those decisions is also kind of poor.
Right.
But having said so, about, say, mutual funds, SIPs, I think it's a more, it's a more organized way of approaching the market.
Okay.
And, these are, SIP is just a facility. Ultimately, the money goes in mutual funds. But these are more organized ways of approaching the market. You're entering the market, but there are some guardrails. Like, when there is absolute mayhem or panic in the markets, individual stocks can fall 30, 40, 50%. But all said and done, a mutual fund would fall relatively lower because, they've diversified a portfolio and they're operating with a particular framework. So all of that is ultimately channelizing money in the capital markets. But when you have a professional manager, it's just like, you have some guardrails along which you're going to go.
And you're moving into a slightly crazier territory of investments, like these days, crypto, NFTs, metaverse. It's all the hype, right? And personally, I'm a huge proponent of it. Coming from a tech background, I really like investing in crypto and NFTs. But I just want to understand, how do you see all these new investment classes?
So, I mean, if you really ask me, as an asset class, as an alternate asset class, I'm sure it has a future. I have no doubts in it. See, I'll put it this way, that blockchain as a technology is very valuable, and that can, by the way, I think blockchain has a big role to play even in real estate, for instance.
Absolutely.
Because if you're talking about digitizing land records and easing transfers and all, it will really be a big tailwind to the real estate market if everything is on blockchain. But talking about cryptos, it's just that I personally feel that governments will have some view on it, which is already visible now.
It's taxable now.
Correct. Yeah. So I think the concept is here to stay, and I think it can be an asset class. But now which one and under what circumstances, how it evolves is, I think, something which I would really watch out for. That's the whole point. The second important thing is that since I don't understand much about cryptos, what I do is that, let's say, for example, there is any Clubhouse or any Twitter spaces, anything where people are talking about cryptos, I kind of, plug in and listen as to, what people are saying, what are they thinking. So I find that most of the people, they are, of course, very, very sound in terms of technology background, and their understanding will be superior than most of, at least people like me. Compared to me, their understanding will be superior. But what I find is that people who are investing in cryptos, their general appreciation of markets in general, like capital markets, human behavior. Like, for example, when it comes to capital markets, when it comes to economics, it's well known that last many times, the Nobel Prize in economics has gone to people who study human behavior, not to people who study classically what is economics, right? So what I find is that the whole tech, the whole tech ecosystem, they invest in cryptos, they appreciate cryptos, their knowledge will be more than any of us. But what I find is that they should spend time in appreciating capital market concepts, in appreciating taxation, in appreciating how regulation works, and more importantly, like how regulatory framework actually works. Otherwise, what will happen is they'll end up spending a lot of time reinventing what otherwise has been done. Like, for example, if I'm in the capital markets, I know what I can say when I'm communicating to investors. I know what is the regulatory view. I know what is the government view. I know how taxation works. Right. So if you're talking real estate, if you're talking capital markets, stock markets, bond markets, all of it works in a framework. Right. So if we think that when it comes to crypto, no framework will apply, I think that will be slightly short-sighted.
Absolutely. I think that's also because it's a new investment class, the rules around it and the way it's evolving.
I think it's a new investment class is beyond any doubt, and of course it has a future, that is also beyond any doubt. But just like everything else falls in a framework, this will eventually fall in a framework. But there is one difference. The difference is this is all innovation by tech experts, right? But all of those tech experts will ultimately have to go within a particular framework, right? Like real estate was largely operating outside the framework 2 decades back for a different set of reasons, but operating outside a framework. And now it has fallen into a framework. 30, 40 years back, when you talk about stock markets, 30 years back, there was no Securities and Exchange Board of India. There was no demat accounts. Brokers were largely unregulated.
Right.
But everything eventually falls into a framework, and it grows a lot more and grows healthy when it falls in a framework. That's the point. Only thing is that when from outside the framework, when you get pulled into a framework, that's a transition that you need to watch for.
Absolutely.
It's now being pulled into a framework. It's just the beginning.
We're starting to see that now, the transition there. That's very interesting.
One thing in crypto is, obviously, I think there are two things which will kind of lead to evolution in crypto. One is, as you said, regulatory framework. It should fit in a particular framework for mass adoption. The other, which I believe is lacking from crypto, is that a lot of people are betting on it based on future scope rather than a particular asset which is backing it. So do you have any particular views on that?
No, basically, I can only give my 2 bits based on what I've seen of different markets and different asset classes evolving. Specifically, I already said that, I don't have much knowledge about it. I can tell you one thing, that betting on the technology would be probably easier than betting on a derivative of the technology. Like, as you'll appreciate, the technology is very valuable and the technology is the core. And crypto is an application of blockchain technology. So which currency and how it will evolve, what it will eventually be backed by, where will the backing come from, all those things one needs to see how it plays out. It's more like, for me, it is just watching and learning.
Got it.
Yeah.
So I mean, so there's a lot of wisdom which we covered in the talk, but we would love to know what are your top, so it can be anything, maybe an article or a book, but what would you advise everyone that these are the books where you learned your core process? Maybe top 2, 3, 4 books on investing.
So there are different ones. Like when it comes to investing, for instance, like I love reading, but when it comes to investing, for instance, let us say, I quoted one, which is Expectations Investing by Michael Mabuzin. There is, for instance, there's a book called Investing: The Last Liberal Art, which is written by Roger Hackstrom, right? So these are just a couple of examples. I read a lot on business, for instance.
Okay.
Like when we all are in, say, B school, we've read Michael Porter.
Yeah.
I personally think that everybody claims that they have read. I don't think anybody has read it fully, because if you go back to B school, you know that they are like really comparative strategy and comparative advantage, really big books. But there's another book written by one of his disciples called Joanne Magreta. It's called Understanding Michael Porter. That's an interesting book. Then, for example, there is a book called Eating the Big Fish, which is again on business strategy. It's written by a guy called Adam Morgan. Then I read a bit about communication. For example, there is a book on introverts, which is written by Susan Cain. It's called Quiet. Then sometimes I have read on, general things. Like, for example, there's this book on books by Cal Newport. One is Digital Minimalism.
Yeah.
Then there is another one, I'm forgetting the title, but it's about, how do you organize yourself and how do you become more effective. So I read on a wide mix of things. It could be business, it could be strategy, communication, investing, it could be multiple things.
Got it. So something obviously emerging is investing in startups, right? So do you follow startups, and what do you think of venture capital? Because that is a different ball game itself.
Yeah.
So what is your thought process on it as an investment from a risk and reward perspective?
Yeah, so I'll give you a very framework kind of thing. See, what happens is that if you are a equity investor,
yeah.
So first is that obviously I have restrictions because I'm myself in the equity field. And like I said, when it comes to invest in equity, I would invest in whatever Whiteoak manages. So generally, I don't do personal investment. But 2 or 3 things I can tell you. One is that if I approach it from a framework perspective, then any equity investor, who's hardcore committed equity investor, will have to eventually think of investing in private equity. The reason is because private capital, alternate investments, this become very big. When we talk about equity, we talk in terms of outperforming the market, generating alpha. Now, the fact is that private capital or private equity has become so big that a lot of alpha gets captured when the company is private. And previously, companies which came to the stock market, they were very nascent in terms of their evolution. Today, you can see in India itself, companies come to the stock market when they're already 5, 10, 15 billion market cap.
Yeah.
Right. So a lot of the value has been discovered and extracted when it was a private company. I hope I'm not wrong about the numbers, but I think Uber got listed when it was about 100 billion market cap or something like that. Right. So if you are a equity enthusiast, then you have no choice but to take some interest and see how you can invest in private equity. Not everybody's cup of tea. You need the right capital, you need risk profile. But if you're purely talking in terms of maximizing your return and you're an equity enthusiast, but then you have no choice but to take some interest in it.
As an equity enthusiast, I believe it will be very hard for them to adapt to private equity, because in private equity, you're getting into it in a very early stage.
Yeah.
You're mostly backing the founding team or the company that they've built. So do you follow anything when you're investing in startups? Being from an equity perspective, you're looking at financial statements, which might not be true when you're looking at startups.
Yeah, so of course, you are backing ideas and you're backing hypotheses. To the extent, there is one commonality. One commonality is that ultimately every investment you make is a hypothesis on the prospects and a hypothesis on the execution. See, out here, when you talk about private equity, the execution track record is not there, but the hypothesis you make on the prospects, or what you would say, the addressable market and the whole business idea. So some of those parallels are there. Obviously, you are coming very early, so you don't have the execution track record. That is where the founders will matter. So for example, if I have to invest, I would basically invest with some fund managers who have a good track record, and I would bank on them to actually make the investment. That's how I would do it. But I think that, everything said about risk perceptions, etc. But still, I think if you are participating in equity and you want to outperform and you want to maximize your gains, then I think, companies are going to come to public markets at a much later and later stage. So you have to at some point in time get in. In the US, I don't know if everybody is familiar, but in the US in the last 25 years, the market cap of listed equity has gone up 3x, but the number of listed companies has become half. That tells you that the number of small companies is on the wane, because more and more companies are coming into the market after they have already become mid or large cap. And good part of the small universe is still in private hands. So either it is private equity, or it is buyout funds, or it is those SPACs which became very famous. So in whichever way you look at it, in US, a lot of action has already moved to the private market. And the public market has become mainly for, large companies, efficient companies, price discovery is done. That's why they are struggling to generate alpha. Not now, but in 10, 15, 20 years, you will see those trends in India, and you will see that, private equity investing has become ubiquitous. I mean, it becomes more common.
Got it. So you mentioned the word alpha a couple of times, and in general, everyone would like to know, right? What is the true meaning of generating alpha?
See, so, if we are investing in equity, for instance, we'll have a corresponding benchmark. So you will go to a manager only if that manager can do better than the average market.
Yes.
Average market is always represented by a benchmark. So if you take a benchmark of large companies, it is Nifty 50. If you take a benchmark of the whole market, it's BSE 500 or Nifty 500. So managers' performance or investors' performance will always be evaluated from perspective of how much did you do better than average.
Yeah.
Because when it comes to, see, the least that, let's say you're a novice, you have no clue. The least you should be doing for yourself is that, you buy a Nifty 50 or a Nifty 500. Because it's like this, I always tell people, if you don't know what to buy, you buy the market. Correct?
Yeah.
So you just buy the asset class in general. Now, when we are talking alpha, we are basically talking about doing better than the market. So in both those references, when I mentioned that, okay, you ultimately alpha will move from public market to private market. Public market becomes more and more well discovered, more and more large cap, more and more efficient. Private market is where, so that's why I mentioned that if you want to outperform, ultimately you will need some participation in the private markets.
Got it. So finally, coming to the crux of this podcast, we would love to know your advice on how should someone build their wealth in a more smart, it is a general question, but what according to you is the best way to build wealth?
See, I think never get carried away by the easy or the quick remedies. Because when it comes to easy or quick remedies, there is very high survivor bias, meaning that only the guys who got lucky, they are there to say their story. But so many fall by the wayside, nobody gives you their story. So there are a lot of failures. There's no way to do it quick and easy. Correct? I think that, the commencement for youngsters, the beginning of creating wealth, I think is a lot in terms of reading. You need to read the right things. You need to get the right, grounding. Because if you have exposed yourself to the right people and to the right resources, then I think you are more likely to, make good of something. So getting knowledge, reading, right exposure, I think those things are very, very important. Second thing is that being being disciplined. I mean, boring, and very, very heavily emphasized by people. But I think being disciplined is very, very crucial. And the third is, I think for today's generation, really being passionate about your work or working in something which is passionate, because the opportunities are a lot more. Right? Opportunities are a lot more. So if you are working with something which you are passionate, then I think from your career you can create a lot of wealth. Because we are not 20 years back. 20, 30 years back, the only way people created wealth was, either, he or she, whoever, either it is by, married right,
Yeah.
which is doesn't fall in any framework.
Yeah.
But other than that, talking more seriously, it could have only been through your working, through your salaries, and then saving for 20, 30 years. So that was the tough way of doing it. But nowadays, we are in a more entrepreneurial setup. If you're working in the right places, if you're passionate about your work, or you work what you're passionate about,
Yeah.
then I think your career can actually also, at least that avenue has opened up. So it's not just about working and investing. Now even careers can be very, very lucrative. So the choices that you make will really
Yeah.
matter.
Perfect. We loved having your time and your presence in this podcast.
Thank you.
Got to learn a lot. The three of us as well as everyone viewing the podcast. And I think thank you so much for your time.
Thank you.
Yeah.
Thanks for having me. Thank you.
Perfect.